All right, let's stay on the jobs report and talk a bit more about what to take out of these numbers. We're joined now by Joe Brusuelas. He's the chief economist over at RSM. We're also joined by Emily Roland, the co-chief investment strategist at John Hancock Investment Management. Thanks to you both for jumping on this morning. Joe, let's just start with your view on this jobs figure and kind of how you're thinking about these numbers, given we've seen a 900 plus thousand non-farm payroll report.
All right, so not only were the jobs created strong across the board, they were also clustered in some very high-paying industries. If you look at those additions in goods producing, 183,000, construction, 110,000, manufacturing, 53,000, government, 136,000, education and health, 101,000. This is the boomer of a jobs report. Moreover, you add in the, 156,000 back revisions over the past 2 months, we had over 1 million jobs. Turns out my forecast of just 1 million wasn't quite optimistic enough. Hey, look, when you look at the composition of this, I come to one conclusion: the best is yet to come.
So if the best is yet to come, Emily, is the best yet to come for the markets, right? I mean, it feels like stocks have been pricing in some pretty optimistic numbers when it comes to GDP, when it comes to jobs. Are they? Or, I mean, we're seeing futures take a leg up. How are you thinking about these numbers?
Yeah, thanks for having me this morning, everybody. And Julie, I think you're right. This story is really becoming about the economy just booming this year. And in some sense for investors, that's kind of a gimme. We're coming off really depressed levels. We still have 8.5 million jobs left to restore, but there's a lot of momentum right now. And this report this morning was awesome. We are seeing futures up here a little bit. Bond market, you're seeing a little bit of a backup in treasuries, but a lot of this has been priced in. So if you think back to 2020, that was really a market of multiple expansion, of stocks moving higher in anticipation of this reopening, in anticipation of vaccines being rolled out in the US. And now it's really more of a show me story. Is the hard data going to show up and exceed or meet these lofty expectations then that the markets have priced in? And in our view, it's going to be a little bit more challenging to get those exceptional returns in the market as we head forward. We are confident that this better economic backdrop will feed through to corporate earnings. And so we do think that earnings engine is going to be there in order to kick markets into gear and continue to climb higher here this year.
So Emily, in addition to the headline coming in strong, 916,000, you had 156,000 worth of upward revisions to jobs in January, February. So all that is good. Positive. Clearly, the economy is kicking into gear. So come Monday morning, are you rotating out of value and back into growth? Because I would make the argument that it's time for growth to start picking up here. It hasn't done well, but these jobs numbers say growth should be doing well in this type of environment.
I would expect the rotation into more cyclical or economically sensitive parts of the market to continue here. So, I do think that value will continue to catch a bid as the economy is turbocharged here with more fiscal stimulus and with vaccine rollout. So that really benefits areas like financials and industrials, which are our favorite pick. The other way that I would think about this, though, is from a U.S. versus non-U.S. equity standpoint. This report is providing further evidence that there is a multi-speed economic growth backdrop unfolding here, with the U.S. economy accelerating faster than the rest of the world, with potentially the exception of China. So for us, that's meant having an overweight to U.S. equities, looking to areas like U.S. financials and U.S. value to play the cyclical rotation, and having an underweight to European equities, as unfortunately their economic growth backdrop is stalling a little bit.
Joe, you mentioned the best is yet to come, at least, kind of in your view, given what we've seen in these numbers. How unique of a period then, given kind of how you've seen the economy evolve over your career, how unique a period are we heading into where we're going to be looking at 7-figure job gains? We could be looking at GDP prints in the high single digits, maybe even a 10% quarter at some point this year. And how challenging might it be for investors in the broader kind of, market community to see through these numbers, understand them for what they are, instead of have the inflationistas come out and start calling for overheating and all these sorts of things that you know are certainly coming.
Okay, this is going to be the best growth we've seen since the 1980s, the best job creation we've seen in terms of the composition since the 1980s. Just because you're seeing an economy reflate does not necessarily follow that you're going to have inflation. In fact, I think one of the major arguments back in the 1980s was, wow, we can have quality growth without having inflation. And I would make the case that, well, we're going to see inflation rise just due to year-ago base effects, largely due to the recovery in the price of oil. Remember, a year ago, March, oil was averaging $31 a barrel. It was $61 a barrel last month. So you're going to get the arithmetic of that. But then you're going to see it ease simply because this economy is just ready to take off. When you unpack those numbers further, you can begin to see the reflation in restaurant and bar hiring. That's where a lot of the damage was. Now, I do think that there are two major policy takeaways here. First, when you take a look at the fiscal aid that's in train into the economy, I think you could see better reports in April, May, and or June. I mean, you're going to see some really, really strong numbers here. Second, I think this does pull forward the clock when we're going to see the Fed begin to openly talk about tapering operations later next year. And of course, that will likely pull forward the first rate hike into 2023. Now, I don't think the Fed's going to move off of one report. But if the type of composition in terms of hiring, and of course, you're going to see some nice wage data going forward as people begin to work again, in addition to the trillions of dollars sitting in cash accounts and in household savings. It's hard to make the case here that you're just not going to see the best economy in anyone's memory, really, in our career arcs. This is going to be just an exciting year, and I expect 2022 to be just as strong.
Well, Joe, let's stay on policy here because clearly the economy is kicking to high gear. I remember you telling us last month we'd be looking at million-plus job gains in the months ahead. Yep. And I imagine this is a pretty good day for the Biden administration. Does this make the case easier for him that this economy can handle higher corporate taxes? This economy can handle higher taxes on people making more than $400,000 without, the economy tanking?
Right, and we saw that in the 1990s when taxes did go up, but the rate of growth was so strong, people really didn't notice. I think if I'm thinking about this, well, pre-tax hike, I would have thought next year we'd have about 5% growth. Well, that may be closer to 4% if they follow through and get the sort of tax plan that they're proposing. We're in early days. We don't know. We're a lot of speculation here. I think in terms of policy, though, you see growth like we're going to see this year. You see these employment numbers, people start to feel a lot more confident. That gives the Biden administration greater degrees of freedom to pursue their very ambitious infrastructure policy. As an economist, when I look at that infrastructure proposal, I don't really see spending. I don't really see taxes. What I see is, okay, if they do this, this will result in a 0.4 to 0.5% increase in productivity per annum. Now, today, productivity means very little, but over the long term, it's absolutely everything. That's how we increase the living standard, the overall welfare of the economy and the nation. You stick the landing on vaccines, you stick the landing on resuscitating the labor market, people are going to let you engage in transformational projects such as infrastructure. So one would imagine our friends over at the Council of Economic Advisors inside the White House, big smile on their faces as they're looking at their terminals this morning.
All right, Joe Brusuelas, Emily Roland, thank you both for jumping on this morning. Hope you guys both get to enjoy a long weekend on the other side of this. And I know we'll talk to both of you quite soon. Really appreciate the time this morning.
Thank you.